Dividend stocks 2023. Recording this now as we're in a bear market, down more than 20%. And so let's talk about dividend stocks, some of the advantages, disadvantages. A lot of people are enamored by them, and for good reason. They can be an excellent part of your total portfolio. But there's downsides as well that sometimes people don't think of, and you really need to before you make your final decision as to how you're going to invest. So for the first time ever, by the way, I am revealing to the public the Top Dog Trading Table of Trading Truth and Justice. And you can see it there in front of you. So let's employ this now for your benefit. So the big advantage of dividend stocks, of course, that everybody loves is that they do pay a passive income. And who doesn't love passive income? Passive money? That's great, honey. We love it. So that is a huge advantage. Absolutely. In your retirement, you can hold dividend stocks and make some money, or even before you retire. So that's the big draw. And it's a good, absolutely fantastic. We love that. Another thing that people don't often think about is, again, now that we're in a bear market, so this is a very timely video, how do you offset if you don't want to sell out? Big problem people have is that they buy at the top and they sell at the bottom and they're doing everything back. So if you're going to dollar cost average in, which a lot of people do, well, how do I mentally stay in and financially stay solvent during these bear markets? How do I offset the losses that I'm getting on my stocks as the price of the stock goes down? So there's several different ways of doing that. I like some option strategies, but today dividend stocks can help do that too. Because even though the price of the stock is coming down, those dividends continue to come in, and you get those monthly, quarterly, semi-annual, annual dividends, whatever they may be, based on the company that you have. Another one is that you're generating cash without selling the stock. So let's say that you have a stock you love and you don't want to get out of the stock. You don't want to sell it, but you want to make money just for holding the stock. Well, that's awesome. And so that's one thing that dividend stocks allows you to do. You can take money out of the stock, so to say, without having to sell any shares. So you get the best of both. Another one is, and this is a big one. This one's huge. Cash reinvestment compounded. So we mentioned dollar cost averaging already. By the way, I've got another video I recently did on dollar cost averaging. Check that out, YouTube. I'll put a link to it in the description below. So there I go in a little more detail about dollar cost averaging. But what I want to focus on here is normally when people dollar cost average, they're taking money out of their earnings, or they're taking money out of their cash accounts, whether it's savings or checking or whatever, maybe another investment. And they're periodically putting that cash into the stock market. And that can be a good strategy, but again, got to take money out of your earnings and so forth. So here with dividends, you can actually take those dividends and reinvest them and get that exponential growth, get that compounding work for you without reducing your income. Very, very powerful. And usually a broker, by the way, not all financial vehicles allow for this, but many do. And so for those that do, usually your broker have a little button that you just check if you want to reinvest the dividends automatically. And it's a great way to automatically dollar cost average, or DCA as it's called. Often these are safer investments as well. So if being a little more defensive is important to you, especially if you're getting closer to retirement, you want to play it a little safer. Again, it's not a black and white issue. Not all dividend stocks are safe investments. In fact, here's a little tip for you. People are often drawn to the high payout dividend stocks, and usually those are the ones that are less safe. There's a reason that they pay those high dividends. They're trying to attract more money, and probably because they need it, which means maybe they're not as secure, not as safe. So don't go by just interest alone. Just don't go by the dividend rate alone and try to get those high percentages. Really look at the company, and the safer companies will usually pay a more modest dividend. So it's a balancing act. So if you're interested in this, one way to, and again, I'm not recommending anything in particular here, please talk to your own financial advisor and find out what's right for you. But one popular way of doing this is what's called investing in the dividend aristocrats. And these are companies that have continued to raise their dividends periodically and consistently year over year, over year, after year, over year, over year, over year, many, many years. And that shows strength, the fact that they could do that for so many years, usually decades. It provides a good clue, at least, that these are very safe companies. Now, don't get too excited. Usually the amount that they raise the dividend is a very, very, very small amount. But again, it goes toward the stability of the company. And there's even ETFs if you don't want to research all of it and find out, which individual stocks to invest in. There are ETFs that will actually help you invest in one basket of dividend aristocrats. And then finally, REITs, real investment trusts, MLPs, master limited partnerships are very famous for paying interest and paying dividends. Just be careful. They can have different tax laws and so forth. So again, very, very important before you do anything, talk to your financial advisor about what's right for you at your age with your risk profile and your financial situation. Now, let's go over to growth stocks. So, one of the positive things about growth stocks is because they don't pay out a dividend, they don't have to take money out of the company and pay it to you and me. They have more money to reinvest and grow the company. So potentially, again, none of this is a given, potentially they can grow the company and therefore grow the price of your stock investment more. So definitely they have potential. I shouldn't say the word definitely, but they definitely have the potential. How about that? We'll put two words together there. Bigger upside after the bear markets. So again, timing becomes an issue here, but when you start to think, okay, maybe I'll start dollar cost averaging toward the end of a bear market, it's been going on, you're starting to feel like or look like you're even better than looking or feeling or thinking, but you do some research. And you say, all right, I got a lot of time horizon here left in my life, and I want to start dollar cost averaging, but I want to get bigger returns. And now that we've already given back a lot of money, I'm looking at the long-term horizon of the stock market, and I want big, 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 big returns. So I want to get those big growth companies. Okay, so now downside is, of course, you don't get any cash out of your investment until you actually sell the stock. And again, that's going to depend on what your needs are. Also, a downside is you don't get the natural compounding of reinvesting the dividends. So if you want to do the dollar cost averaging, the compounding, then you got to put in cash from your own resources. Potentially bigger returns long term. So again, this is where you talk to an advisor can tell you. By the way, there's another thing here too. So not only how much time do you have left to retirement, but also, and a lot of people don't think about this, your personal risk profile, your psychological risk profile. How risk averse are you or how aggressive are you? And this is so important. In fact, a good financial advisor can often give you a test that you take, and that will help to measure what your risk profile is. You might say, well, Barry, why is that so important? I just want to make a lot of money. Yeah, just that alone, saying that statement is a red flag, because that means that you're not risk averse enough. And there's a balance, and each of us is a little different. And there's no right answer here, but there's a right answer for you. And what happens is it goes toward, well, can you sleep at night? So you don't want to be in an aggressive investment, not be able to sleep at night, relax, and have your life filled with stress. Your quality of your life is very, very important. And again, we don't know. Just because you're in a high growth company doesn't mean it's going to be a high growth company 10 years from now, 5 years from now, 2 years from now. It could go bankrupt, right? Maybe it's taking on more risk in order to get that big growth. So what allows you to be able to sleep at night where you don't have to think about it too much? Quality of life. So to invest in these, again, you could go into individual high growth companies that you like, or you can go with high growth ETFs. There's plenty of them out there, where again, you get a basket of these companies, and you don't have to do too much homework on your own, just a little bit. Generally, the areas that I look at are small caps, disruptive technology, emerging markets. So these are the kind of opportunities that I look for toward the end of a bear market. For again, will be up to you. Timing, as you've heard me talk about here, timing, very important. So when I do my day trading, I rely very heavily on timing my entries, because there I've got to be very accurate, very specific. There's not much room for error in day trading. Swing trading, same thing, really. And investing, the same thing. When I invest, really all I'm doing is I'm using monthly and weekly charts instead of daily charts or 60-minute charts or 1-minute charts when I'm scalping. And I've got a great timing indicator that I use for every single entry. I'm happy to give to you for free. It's my gift to all of my viewers, meaning you. And I'd love to give it to you. So get my timing indicator at indicatorwebinar.com. I show you how to set it up on your charts. By the way, it's an indicator that's already in your charts, but we modify it because that's not inherently a timing indicator or market entry indicator. So we turn it into one. I show you how to do that. And then I show you how to set it up on your charts. And then I show you how to trade it. All of that for free. My gift to you. And that's one of the best things I've ever come up with. I use it on every single trade I take, in fact. That's how it is. And by the way, also subscribe to the channel. I'll be doing more videos. I'm trying to do 2 to 3 every single week now. I'm upping the ante. And we've done a whole series. In fact, check the description down below. There'll be a list of some of the most recent videos that are all around the same topic of longer-term investing. And then after this, I'll get back to some trading videos, but you want to get notified when all of them come. So subscribe, check the bell, and to be notified whenever I come out with a new video.